In this video, we are going to discuss some other terms. Expense. Expense is the cost which is incurred by the business in producing goods and services for selling purposes. The example is cost of goods sold or cost of goods sales. The next is income. Surplus of revenue over the expenses is called income. We can calculate by using the formula in which revenue minus expense is known as income. Profit. Excess of revenue over total expenses of a business entity is known as profit. Profit may be of two types: gross profit, net profit. If total of revenue exceeds expenses, it is a net profit and it is added to the capital of the owner. On the other hand, if the total expenses exceeds revenue, it is a net loss and it is deducted from the capital of the owner. Gain are the profits that arise from those transactions which are incidentals or which maybe happen sometimes. That means they are irregular in nature. Loss. The owner's capital is reduced to the extent of amount of loss. Loss examples are loss of goods due to fire, accident or theft. It is the loss to the business. Purchases. Purchase is used for the purchase of goods. The example of purchase is purchase of furniture, purchase of motorcycle, but the main business according to motor vehicle. If goods are purchased for cash, it is cash purchases. If goods are purchased on credit, it is credit purchases. Both terms are recorded to the trading account. Purchase return means goods purchased from the supplier may be returned due to some effects. It is also known as return outward and it is deducted from the purchases to calculate the net purchases and it is debited to the trading account. Sales. It is used to only those goods in which firm is dealing. Example, a shopkeeper selling electronic items is a sale, but if he sells old furniture, it is not termed as sale. Sale may be cash sales or credit sales. Cash sale and credit sales both are recorded on the credit side of the trading account. Sales return. If goods returned by the buyer is known as sales return or it is also known as return outward. Stock. Stock is also known as inventory, which include the value of goods. Stock may be of two types: opening stock, closing stock. Stock is specified in balance sheet under the head of current assets. Trade receivables. It is the combination of debtors and bill receivables. Debtor is a person to whom goods have been sold on credit basis are known as debtors. Debtors are shown in the balance sheet under the current head of assets. Bill receivable is written by the seller of goods on the buyer of goods directing to pay the specified amount but at a future date. Bill receivables are also current assets. Trade payables. Trade payables are the combination or sum total of creditors and bill payable. Creditors are the persons to whom We have purchased goods or services on credit basis. Creditors are shown on the liability sides. Bill payable. The buyer of goods who accept the bill of exchange drawn by the seller become the drawee of the bill. Bill payable is an acceptance given to the seller. Bill payable are shown on the current liability side. In the balance sheet,